All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Salesforce getting downgraded at RBC Capital Markets. The analyst cites execution risk in the company's acquisition of Informatica and also questions whether it was necessary to own the company instead of just partnering with it. Shares down about 6%. Next up, we have Southwest getting upgraded to a buy over at Deutsche Bank. The firm says that the airline's refreshed board of directors will usher in a new era of change, which should drive higher shareholder returns. And finally, we have Starbucks downgraded over at TD Cowen. The analyst flags the risk of slowing sales thanks to deteriorating value perceptions and increased competition. Meanwhile, Wall Street also taking a shine to a buzzy new deal. e.l.f. Beauty announcing it will buy Hailey Bieber's Rhode brand for $1 billion. Now, this move gives the cosmetics retailer access to a product line that has become hugely popular among Gen Z and millennials. As a result, you have Raymond James, Deutsche Bank, and Jefferies, just some of the firms that are raising their price targets on e.l.f. following this news. And I'm pleased to say that here with us now is the company's CFO, Mandy Fields. Mandy, it's great to have you with us. Talk to us a little bit about why this deal makes sense and why now specifically.
Well, thank you so much for having me. We are so excited to welcome Rhode into the e.l.f. Beauty family of brands. We found a like-minded disruptor. I mean, if you think of what Hailey has done, built a business from zero to $212 million in 3 years on 10 products online. It's just incredible. And she did it profitably. And so we saw this business and just the kindred spirits of disruption and community, her ability to attract so many people into this brand, we had to bring it into the family.
It's interesting. I mean, you think about the experience with Kylie Jenner. I mean, she sold her beauty brand, I believe, to Coty, and then eventually brought it back. I mean, the fact that you're partnering with a celebrity founder here, did that add any additional levels of due diligence into the thought process?
Well, we spent a lot of time with Hailey and the team. You know, I've talked with Hailey about kids, about, family activities. I mean, she is just so down to earth. And we really don't see her as a celebrity. Stable. A real founder with great instincts, a great aesthetic, and we're very excited to partner with her.
I can't imagine anyone more stable than Hailey Bieber and Justin. God. They just live such a normal life, Mandy. I want to ask about the exposure that you have to China, especially considering what we saw yesterday out of this court. I mean, how much uncertainty is there surrounding trade for you and your job?
Well, the tariff situation is one of the main reasons why we did not provide guidance on our call yesterday. There's just such a wide range of outcomes when it pertains to tariffs. And so until we have more certainty on that front, we're just going to wait and see what happens.
Yeah, and it's interesting. According to our Bloomberg intelligence analysts, your exposure to China is pretty high, about 75% of your cost of goods sold. And how do you handle that? I mean, do you try to move manufacturing to other countries? We know that that hasn't exactly worked out well for some other industries. Or do you try to move it back to the United States? How do you even start to blueprint that?
Well, we have a tariff playbook, and it really consists of 3 things. 1, pricing, 2, supply chain optimization, and then business diversification. And we've made progress across all 3 of those things.
I want to ask about your marketing. You've done some work with Catherine Lega in NASCAR that I've noticed, and now this sailor guy on Instagram who's going from Oregon to Hawaii, he has millions of followers. You dropped a care package off to him, which I thought was just brilliant. How do you come up with these ideas? How much do you save on marketing? Because that's not, some $1 million drop. You just rent a plane and give him some snacks.
That's right.
How much is a drive? How much of a drive are these things to your bottom line?
Well, it keeps e.l.f. at the top of the conversation, and our marketing team moves at the speed of culture. And so they are so in tune with what's happening in the community. I have to tell you, I did not know about Oliver's journey before we did that drop, and now I am like all in on it.
All in. You know, I have not been following this at
I'm all in. This guy quit his corporate job. He had a 9-to-5 that he hated, cashed out his 401k, bought a boat, and now he's sailing around the world alone. Well, with his cat.
With his cat, yeah. I don't know. I don't know if I love that the cat is on the open ocean. But Mandy, let's get back to your brand a little bit more. And I want to talk a little bit about how you acquire new customers, especially you think of beauty trends. They change so quickly. As I mentioned in the intro, I mean, Rhode is very, very popular, particularly among Gen Z. Unfortunately, I spend a lot of time on TikTok, and I can see that very viscerally. When you think about, again, the logic for buying Rhode at this point in time, was it really about trying to reach those younger consumers?
Well, as you know, e.l.f. also is very popular with Gen Z. And so, again, just like-minded disruption and that connection with community that is so important. You know, you look at Rhode and you see some of the pop-ups that they've had. People are waiting 14 hours in line to get access to this brand, to be a part of this lifestyle. And it's just really incredible. It's similar to what e.l.f. has done. I mean, we are so close to our community. A lot of our innovation is inspired by our community. And so both of us coming together really have an opportunity to be very community focused and disrupt this industry.
Mandy, we were talking a couple of days ago with Stefan Tanda from Aptar. They make packaging and dispensing products for the beauty and health care sector, maybe for you guys as well. But one of the things that he said was a reduction in airline travel is difficult for them because you sell fewer of your goods at, you know, duty free, and airports are a great place to buy that kind of product. Have you seen that as well?
You know, we're not available in duty free, but we continue to see demand for our brands. I mean, we grew our market share 190 basis points in this last year, and that has continued into our latest quarter. And we continue to see consumers asking for e.l.f.
All right, Mandy, great to have you on the program. Thanks so much for joining us. Mandy Fields there of e.l.f. Beauty, talking about her their acquisition of Rhode, Hailey Bieber's beauty line, and also some pretty cool marketing tactics. Let's get to some retail movers on our radar this morning, 20 minutes into the session. Kohl's affirming its full-year outlook after firing its CEO. This quarter, we talked about that quite a bit.
Yeah.
Very interesting story.
It's very interesting, both what's going on in their C-suite. They're still looking for a new leader. They have an interim CEO in Michael Bender right now, but
maybe better due diligence this time.
Yeah, but it's interesting. I mean, you compare it together with what we heard from Macy's yesterday, and maybe it's not all bad for retail right now.
Yeah, exactly. Foot Locker sales missed estimates, but it's awaiting approval for its merger with Dick's Sporting Goods, so I guess the earnings are not as important to this stock. And Best Buy cut its earnings forecast due to tariffs, but you know, I read through some of the statement, some of the release, and they don't really have concerns about tariffs moving higher. They don't have concerns about the consumer reacting negatively. It didn't seem that bad. Nonetheless, the reaction is bad.
That's the thing. I mean, I hear what they're saying, that they see no major change in consumer behavior, but it feels like if you wanted to blame it on something, you could have just pointed to that. But Best Buy not taking that route. You can see shares down about 7.4%. This is open interest.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a check on stocks at this hour. It's really a sea of green here. The S&P up 0.7%, and we've seen almost all of the big tech stocks rally. The Nasdaq up 0.8%. The only red chiclet that I have behind me is the VIX, and obviously, if the VIX is down, that's good for stocks. So, in terms of the biggest movers, Nvidia now a $3.5 trillion stock, adding 5%. Microsoft is not down. The same is true of Apple and Alphabet. Tesla's up 2.4%. Dan Ives says it's great that Elon Musk is quitting Doge and is going to work at the car maker full time. And Amazon up 1.5%, 1.33%. So, Katie, it looks like we're seeing some solid gains, but not really blowing the roof off.
No, not exactly. I mean, you take a look at trading volume. It is much higher than it has been. We'll continue to track that. But coming up in the next hour, we're going to head to the Goldman Sachs Leveraged Finance Conference in California, joined by Sonali Basak. That's coming up next. This is Open Interest.
We are 30 minutes into the trading day. You can see that we still have gains on the board here. 0.6%, 0.7%.
Not bad.
They're not huge.
Not huge. You know, we've really seen that enthusiasm in the pre-market just fade and fade as we get deeper into this Thursday. I will note that volume right now 22% higher than the 30-day average. So people are active on both sides right now.
Check out type ECO Go.
I will do that.
Look at pending home sales.
Are they bad?
Much worse than expected.
Yeah.
Down 6.3% month over month, down 3.5% the non-seasonally adjusted year over year.
Well, mortgage rates are still quite high. We're going to get into that. And we also have a lot to get to. We have to talk, of course, about tariffs. Blocked for now. A U.S. court deems most of President Donald Trump's levies as illegal. The White House says it will appeal.
The AI boom continues. NVIDIA calms investors' fears over a China slowdown with a solid sales forecast.
Well, we got a whole bunch of engines firing right now. The demand is just off the charts. You see the popularity of all these AI services now?
Off the charts. We're also going to get some insight into the intense competition among low-cost airlines. JetBlue founder David Neeleman, he's now the CEO of Breeze Airways. He joins us later this hour.
And now we're going to go live to Shonali Bassick. She's at the Goldman Sachs Leveraged Finance Conference in Dana Point, California. Took the red eye out there and up and at 'em bright and early. Shonali, what have you got going on?
Matt, thank you so very much. It's a good day to talk about risk appetite. There are, from what I hear, about 450 different issuers and investors here to talk about exactly what's going on. And with me right now, I have Goldman Sachs' Christina Minnis, who is the Global Head of Acquisition Finance, and Vivek Bantwal, who is the co-head of Private Credit at Goldman Sachs. A lot going on in both of these worlds. Looking forward to kind of discussing how you see it from different angles. Christina, risk appetite, though. I think that's where we have to start here. There is a lot of push-pull when it comes to the administration, their tariff policies. Of course, that big news overnight about the court blocking the use of IEEPA. How are your clients thinking about risk-taking at a time when the macro is still so uncertain?
Well, delighted to be here. Vivek and I, back 10 years ago, we were together, actually not on this patio, but it's been 10 years of working together, so thanks for having us on the show. And we're delighted to be at our conference, having all these issuers here. And I would say, in terms of risk appetite, I'd say things are pretty measured, but we're starting to see real green shoots of activity. And we see companies really starting to think about, again, how to deploy capital. And from an investor perspective, we've seen some really interesting developments in the markets where larger transactions now are being discussed. And when I say larger, you know, $15 to $18 billion transactions are being discussed. So that's a very good sign for risk appetite.
It's interesting because you have the syndicated loan markets and then you have private credit. I would imagine from a private credit perspective, that type of pent-up activity could be exciting. But what would cause it to materialize?
Yeah, listen, I think that some of that is driven by M&A activity, and so M&A activity will sort of ebb and flow with the macro. I think we all expect sort of M&A volumes to pick up when you think about the sort of age of portfolio companies in the private equity community, and so as they start to monetize those positions, that's going to lead to more M&A, and that'll lead to opportunities for both public markets and private markets and credit. At
what point do people start to get worried about credit deterioration a little more? Things have been pretty complacent, as Jamie Dimon had recently warned. Do you think that the markets are still too complacent, and do you worry that things have to kind of widen out from here before people get more comfortable with taking on some risk?
I think there's a lot of credit dispersion, right? And so certain sectors are very resilient. And so what we see in our credit committee is focusing on which sectors are really exposed potential to some of the macro. And there are a number of sectors that are pretty resilient. And I think what I've seen recently in projections that we've seen from clients is that people have done a pretty good job of dealing with what the perception of higher costs. So I think, at this point, defaults haven't really ticked up, but we're watching it very closely.
What are those places that are immune?
Tech, for example, has had, some great, resilient software, of course. Some sectors within healthcare services have been very resilient. And then some of the distribution business. And then, of course, businesses that are potentially not as exposed to tariffs have seen some real resilience. So there's an openness right now to deploy capital. And from an investing perspective, we see that with our financial sponsors as well.
So if we had this conversation, say, 3 years ago, Christina, how many times have I peppered you about the private credit industry, saying, are they in competition with the Goldman's core business? Now, Goldman has made a big push into private credit in a bigger way. When do clients turn to the private credit business versus syndicated loan markets? How do you think about how those businesses work together?
Yeah, look, we have a very, very close partnership. We've been in the private credit business a long time. We started our private credit business about 30 years ago, and it was really started as sort of a partnership between our kind of asset management business, where I currently sit, and with our leveraged finance business. And so because we have such a big presence in both public markets and private markets, it puts us in a position that whether it's people in my business or in Christina's business, when we're talking to borrowers, we can show them the full menu of options, public and private, and we can really solve for them. You know, think about their use case, think about their objectives, and tailor a solution to them. And so whether that's public or private, we have strong capabilities in both, and we want to really just do what's right for them.
But what are clients choosing ultimately? Because it matters from a supply perspective, doesn't it? If clients want to go private, then it keeps the supply in those syndicated markets tighter, doesn't it?
Yeah, I think the use cases are very specific. So when we present an opportunity set to our clients, we say we can go with a broadly syndicated solution in the loan market, the high yield market, and we have a solution with our partners on asset and wealth management. And one of the reasons we formed the Capital Solutions Group was because we're trying to marry the #1 investment banking franchise with one of the top alternative asset managers to provide these solutions. And so I'll just give you an example. Let's say you're looking at a company that really wants to have a significant amount of delayed draw powder to make acquisitions. In the syndicated markets, you get basically charged for that. And in the private credit market is actually quite constructive around that one feature. Sometimes clients don't want to get a credit rating. And in the private credit market, you don't need a private credit rating. So there are very specific use cases, and what we see is clients switching back and forth very nimbly. We just did a very successful financial services transaction out of the private credit market into the BSL market with a syndicated second lien that was anchored by the direct lenders that had played the unitranche for that company a year ago. So it's all converging, and that's why we've always been very constructive. These markets are going to coexist. The private credit market now in the U.S. is almost $1 trillion. The U.S. and high-yield loan markets are $1.3 trillion each, respectively. These are large markets.
So what does this mean for private credit in terms of the macro also? Because you have the benefit of floating rate when it comes to private credit. You have a lot of investors saying it's a golden moment. You were one of them a few months ago. You said this is the golden opportunity for credit. But for private credit in particular, how do you balance the risk and reward? Because investors are equally looking to see what the cracks are under the surface.
Yeah, look, I think that, to Christina's point, private credit in general tends to be focused on the more stable industries. So it's software, it's, services, it's kind of more stable businesses. But I think private credit starts with good underwriting. You need to get the underwriting right, and you need to take a long-term perspective. And one of the benefits of private credit is that, you're making this investment and, you're planning to hold it for the 7 years until maturity, or if it gets refinanced earlier, but that's really the framework around private credit.
So, higher for longer environment. We were all kind of taking a look and seeing if interest rate probabilities had changed for the rest of the years in terms of what the Fed might do in terms of cuts. Back in April, the market was pricing in as much as 4 rate cuts. Now it's 2 or less. What do you think? I mean, if the rates are going to stay higher, then how is it that companies don't come under more pressure when it comes to refinancing right now?
So look, I think higher for longer is the theme. I was actually looking back 10 years ago. The 10-year was at 1.75%, and we're 4.4 this morning. So it's amazing how the world has changed. And the cost of an LBO back then was just over 6%, and now on average it's in the mid-8s. So it's a couple hundred basis points higher, which means obviously the cost of capital is higher, which puts a bit of a governor on the amount of debt. So the quantum of debt's a little bit lower. It's about a turn lower than it used to be. And so I think companies just have to be much more nimble and very thoughtful about how they manage their businesses, whether it's their CapEx plans or working capital. And yes, probably not taking that last quarter half turn of leverage and thinking through putting a little bit more equity in.
Just keeping the belt a little tighter these days. Yep. So from where you're sitting as well in the private credit markets, one big theme that we're seeing is companies that are coming under pressure from higher rates, whether it's refinancing or whether it's private equity-backed companies that just haven't been able to exit. rescue financings. Are you interested in diving into some of the things that might be appearing, and how big is that opportunity?
Yeah, it's a good question. So, when people talk about private credit, they're often talking about direct lending, but private credit is much broader than that. And so for us, in addition to our direct lending business, we have a hybrid capital business. We also have a private investment grade business we haven't talked about yet. But in our hybrid capital business, we are more opportunistic. We are able to kind of lend more junior in the capital structure, lend to good companies that, to your point about sponsored DPI, if it's a private equity firm that's been in the asset for a long period of time and their exit's been delayed, maybe because the IPO market hasn't sort of been available to them just yet, we can provide capital to help them, kind of extend the runway and, kind of continue to grow their business so they get to the scale that they need to get to an exit.
Sounds like you are interested. Calling card to private equity firms. That is Vivek Bantwal of Goldman Sachs and Christina Minnis, of course, kicking off our coverage here today at the Goldman Sachs Annual Leverage Finance Conference. Guys, back to you.
Janali, thanks very much. Janali Basic there. She's going to be back shortly for a conversation on the future of payments with the CEO of MoneyGram. This is Open Interest. Let's get to high interest to look at what's making headlines around the world. Secretary of State Marco Rubio says the U.S. will start aggressively revoking visas for Chinese students. In a statement, he wrote that students affected would include those with connections to the Chinese Communist Party or studying in critical fields. Chinese officials are condemning the decision, saying it will harm relations. China had the second most students in the U.S. of any country last year, behind India. Chevron is planning to lay off nearly 800 employees in the Permian Basin, its biggest oil production operation. Earlier this year, the company announced plans to reduce its global workforce by as much as 20% by the end of 2026. The CEO, Mike Wirth, says he's trying to make the company more efficient and better able to withstand low oil prices. And LVMH's deputy CEO says Chinese customers have been pulling back on travel, on consumer spending, indicating that a slump in luxury goods has some room to run. The comments come after Bloomberg reported the luxury leader has been warning of softening demand. In the first quarter, LVMH's revenue in the China region fell 11%. It's unclear when U.S. demand will recover in light of ongoing tariff uncertainty. According to the CEO, LVMH will no longer increase prices in its wines and spirits divisions because, quote, we cannot increase prices indefinitely. But they can, and they will. Prices only go up over time. Anyway, let's take a look at stocks. They also, if you look at the bigger picture, Katie, they only go up, right?
True.
The S&P 500 gaining a third of 1%, now at 59.08. It doesn't feel like we're going up that much. The NASDAQ gaining a third of 1% almost, and the 10-year yield coming down to 4.45. It doesn't seem that incredible, does it?
Yeah, in the grand fullness of time, I will say stocks only go up, but there's a lot of volatility for years in certain periods. Let's take a look under the hood, though, and talk about some single stocks. NVIDIA, higher in a big way, up 4% still after delivering an upbeat sales forecast. It actually passed Microsoft to become the most valuable company in the world, and it really has the whole market on its back right now. NVIDIA adding about 16 points to the S&P 500 right now, which is only up about 21 points. You also have Apple rising a little bit on a court ruling and a revamp to its operating system. And then you have Tesla higher as well, targeting a June 12th robotaxi launch. You also have Elon Musk preparing to step back from Doge. Shares up a little bit right now. But let's head back to the Goldman Sachs Leverage Finance Conference in California, where Sonali Basak is joined by the CEO of MoneyGram. Take it away.
Katie, appreciate it. I'm with Anthony Suhu, who is the CEO of MoneyGram. Just over 6 months into the job, what a time to take over for you.
Yeah, it's been exciting. Thank you.
To say the least, I'm sure. Now, your business is very international. And of course, when it comes to these tariffs, how do your clients see the push-pull of what's happening? Do they look at what's happening overnight and see it as a much-needed pause or just a lot more uncertainty?
I think there's a lot more uncertainties in the markets, but one of the things I would say for the core consumer that's interesting is that over 70% of our business is actually outside the U.S. And so when we look at that, one of the things we have noticed is the global worker is very resilient. And so as we're going through this process, what we find is that workers are moving around to make sure that they work in the best places to send money back home. And then the other thing is global remittance or global payments is really a need, not a want. So as a result, I think that we still are trying to learn what the impact really will be for our business.
You know, it's interesting. There have been some fairly drastic currency movements around the world, but also here in the United States.
Yep.
What has that meant for you in terms of the people who are sending money overseas? Has it changed behavior at all?
Going back to the point that it's more global payments is much more of a need versus a want. What we're seeing is amounts are actually pretty stable. What it definitely means is the amount that goes back into the hands of the consumer might be less. And so we're monitoring the situation very closely, and we hope that we learn a little bit more about it, and then we can figure out the best way to serve our customers.
So to the extent that there are cracks in the consumer right now, where are you seeing them the most?
I think what we're seeing is we're seeing a little bit in travel. In terms of how consumers travel and where they're going to, they're definitely taking a little bit more shorter trips. And then outside of that, what we're seeing is that they are going to areas where there's actually great exchange rates from where they're going. And so, both things that make common sense to the individual, where you're going to go, where your purchasing power is the best. And that's what we've noticed.
So as a CEO who's trying to navigate this tariff strategy, how do you navigate it? Have you created a playbook here to get through what the next few months might look like?
Well, I think it's a little like the pandemic in some respects, where we're creating our playbooks right now on the fly, because a lot of the movements in terms of the amount and size of some of these tariffs are meaningful. And so we're monitoring with our team. We're having daily discussions about how to do best. And always, I think the anchor for us is to focus on the consumer, which allows us to be able to make sure that we're anchored on the right things versus trying to make any short-term gains.
Yeah, you're navigating this on a lot of fronts. You're navigating this from a consumer perspective. You're navigating it from international business perspective. It's interesting. I've heard you talk a lot about how a lot of your clients are also immigrant populations. How are they behaving right now, given the administration's stance on immigration? Do you see a change in the way they're interacting on MoneyGram?
What we notice is that a great thing about having a global payments network like we do, just as a backdrop, is we service customers in over 200 countries, 20,000 corridors, with over 450,000 retail locations and 5 billion digital endpoints. What we find about our customers is that they have a tendency to be very resilient. So as one area might be a little bit less welcoming, they're moving other places to work. So they are actually going to where the work is. We've seen huge movements in terms of the Middle East, for instance. I was just in Dubai recently, and I think the population there was over 90% of that population that is actually immigrants or not. And it's exciting to see where the pockets are. And so in our network, what we find is if something goes down in one area, they get picked up elsewhere.
Fascinating. I want to talk a little bit more about MoneyGram itself, though, beyond what your clients are doing, because you have a lot of big plans yourself. You've talked about the desire to go public again. What does that timeline look like?
Well, I would say it wouldn't be this year, but I joined the company a little over 6 months ago, as was mentioned. And our goal is to take MoneyGram, which was a great company at one time that was public, I was taken private, and actually go through a modernization and the digital transformation. And our goal would be hopefully, over the next few years, to take the company back public and take it much more as a digital first, customer focused, modern company in the global payment space. And I think there's going to be a lot more use cases of how people think about MoneyGram and use it.
How quickly do you feel like you need to pivot to the world of crypto also? Because you are seeing that stablecoin bill making big strides in Congress. Do you feel like you need to embrace it in a much bigger way? Do you think that that's the future of payments?
Well, we certainly are embracing it in a big way. We actually think the Genius Act is a huge unlock for stablecoin. And when we think about our business, actually, we think about it from a B to B to C perspective. What we mean by that is stablecoins can make huge impacts for us in terms of how we think about running global treasury, the movement of actually money. In addition, it's going to allow real-time settlements, and it's actually going to make our supply chain of movement of money much more efficient. And then for our consumers, what that means is we're going to put a lot more money into their pockets, because our goal would be to lower fees to drive higher volume.
Anthony, we'll have to pick it up again soon, of course. Things are changing under the surface. That is Anthony Suhu, as we said, just about 6 months, over 6 months into the job as the CEO of MoneyGram.
All right, Shonali, thanks very much. Shonali Bassick there with the CEO of MoneyGram. And still ahead, Shonali is going to be sitting down with the Goldman Sachs Vice Chair, Robert Kaplan. That's at 11:30 a.m. New York time. This is Open Interest. Let's get a check on what's going on in stocks. I'm looking at the move screen, which I think is the most dynamic way to look at these markets. And Katie, I don't know if you made this point earlier.
Yeah.
You made it to me. I don't remember if you made it on air.
I did.
We're only up 16 points on the S&P 500 right now, 17 points. And 14 of that is NVIDIA. So I'll just make it again, just driving that point home, because NVIDIA is carrying this entire market, right? No other stock is adding more than 2 points, and you're looking at Salesforce taking that away. So it's pretty much unchanged without the gain of that $3.5 trillion company after earnings yesterday. In terms of the sectors moving, we do see real estate moving higher. We do see healthcare moving higher. So a little bit of a defensive play, although Staples is doing a whole lot of nothing right now. Communication services, which are those hyperscalers, are actually down right now. And that's a big heavy weight on this market, Katie. So we're not really off to the races as you may have thought we would be looking at futures earlier this morning.
Yeah, and it's interesting to see tech only up less than 1%. It was up 1.6% when I did that sector check an hour ago. So those gains fading. But coming up, we're going to be speaking about summer travel. We'll talk to David Nealman. He is the CEO of Breeze Airways. This is Open Interest. Well, to put it mildly, tariff confusion has created an uncertain economic environment for consumers this year. And heading into the summer travel season, airlines have been reporting a dramatic drop in demand for domestic leisure travel. Joining us to help gauge the summer ahead for aviation, I'm pleased to say we're joined by David Neeleman. He is the CEO of Breeze Airways. And really, if you take a look back at the past earnings season, the story there was that you had major airlines either pull guidance or offer multiple scenarios. So take us in to your vantage point. When you take a look at the next few months, what's the outlook there?
You know, from our standpoint, things are pretty good. You know, I just keep looking at the bookings every day and looking at our summer season. And, you know, I think our people have done such a great job of selecting routes. About 87% of our routes, we have no nonstop competition. So during these times where things get a little tighter, people are a little more concerned. You know, maybe they look a little harder for a lower fare, but they also look for a flight where you have the convenience of going nonstop as opposed to going through a hub. So, you know, we're really cautiously optimistic for the summer, and if we aren't public, but if we had guidance, we'd be holding it firm from what we would have given at the first of the year. So, you know, there is a little softness, but it's being offset by fuel. So we're in really good shape.
Yeah, the fares seem relatively low to me. I was just booking a flight from Islip to Norfolk, Virginia, and I chose the nicest option, and it's only $200 round trip. Is that enough to make you profitable, or are you still posting lower fares to compete and take share?
You know, it covers our expenses. You know, we're not wildly profitable. We expect to be profitable for the second quarter. You know, it could always be higher. We're seeing more softness on the transcon when you look at those transcon fares, but we've gone kind of shorter and shorter. So routes like Islip to Norfolk are just our bread and butter. Relatively short flight. We'll take you a couple $100 all day long. That works for us. And what we find is when our guests fly us, they take a look at the nicer, and the nicest, and they aspire to be in the nicest. So as opposed to other ULCCs where people try and figure out how to pay less, our people actually pay up. And you know, our average revenue per flight is about the same as Spirit's, and we have 100 less seats. So, you know, it's a much better model for the environment that we're in.
Yeah, it's a really interesting model. And I'm taking a look at some of your stats. It looks like you added 29 new cities in 2024. You now operate more than 275 nonstop routes. So what does the future look like? Are you looking to add more routes here? Are you looking to add more cities?
Absolutely. We're up to 72 cities now, 32 states. Like you said, probably 280 routes. There's just so much. You know, we have just this great airplane. It's an Airbus A220. They're brand new. But what's really key is the trip cost, what it costs us to fly from A to B. And we are in routes where it's really hard to make it to fly with an airplane that has 240 seats on it. And that's why you see these ULCCs moving more into, you know, they have overlap of maybe 85%. And we're just the opposite. And so that's where you get yourself into trouble when things get soft, because the big guys have incremental seats that they can price at really low prices. And so it's better to be kind of in your own thing, doing your own thing. And we've got like at least 1,200 routes we've identified that we can fly. So there's at least about 300 airplanes worth of demand in kind of the market where we thrive in.
Well, and you keep expanding your fleet. I think it's 50% year over year. You mentioned that Airbus A220 made, I guess, finished in Toulouse in France. When you buy that, do you fly it to London or Madrid, and then it's used before you bring it back into the U.S. so you can avoid the tariffs?
Actually, it's made in Alabama. Our planes are all made in Mobile,
Alabama. I've actually been to that plant. Amazing. That's so cool. So there aren't any tariff issues.
There are a little bit. You know, ironically, a plane made in Mirabel in Montreal still falls under the ULCC, the USMCA, which is the U.S. Canada-Mexico trade agreement, where the parts in Mobile are right now being tariffed, like the wings, a little bit. So there's a little bit of tariff on it. But Airbus was smart. They have 2,000 people working in Mobile. They're looking at taking that to 3,000, and so they have a lot of leverage. But I think what's really important about this whole tariff situation is the U.S. is a huge exporter of aviation. We have a 6-to-1 ratio. We exported $124 billion worth of product, and we only imported $20 billion. So we're kind of China in reverse when it comes to aviation. The worst thing that could you possibly do for America is to tariff aviation, because it can only hurt us when you have that much of a surplus. So I've spent a lot of time in Washington, D.C., talking to a lot of the officials, saying, along with other industry people, saying, don't be stupid here. This is we have a great, between Pratt & Whitney and GE and Boeing and Honeywell and Collins and all these great companies, we export so much more than we import. So hands off on aviation, because since 1970, there's been kind of 1979, there's been a truce on aviation where nothing is tariffed, and that should continue. Absolutely.
So, David, you began service in May 2021. My understanding is that you only fly Airbus planes. Correct me if I'm wrong. Why Airbus versus Boeing? Take us into that initial decision.
Well, we do have a few Embraers that we started with, and we're kind of phasing them out by next year that have been great. But the reason we picked the Airbus A220 is, as I mentioned earlier, is because of trip cost. When we fly between point A and point B, we can do it about 25 to 30% less than an airplane that has 100, 240 seats on it. You can say, well, their cost per seat is actually cheaper than your cost per seat. I'm saying absolutely. But if you can't fill the airplane, I'm much better off. So if I have a 25% advantage, I can be making a 15% margin if we're flying the same number of people, and you're losing 10%. And so we can fly in markets. Huntsville, Alabama is one of our great cities. We fly Huntsville, Alabama to Las Vegas, or we fly it to LAX, or we fly it to Tampa, Orlando. But before we came along, you'd have to go through a hub. And so great northern Alabama city, growing, thriving. The Carolinas, North and South Carolina, are the two most in-migration states in the country. A lot of flights in and out of the Carolinas to places in the Northeast, Western New York, where you've had these migration patterns where people can go back and forth between Rochester and Greenville, South Carolina. I mean, who would think that would be a market? But a lot of people in Rochester moved to Greenville, and they're going back and forth. So, there's just huge areas where it makes a lot of sense to have these nonstop flights. But you need an airplane that has a lower trip cost, not a regional jet that's inefficient because it's a what we call a scope airplane, because of it's forced to be a smaller size, but something right in the middle that really nobody else is taking advantage of.
David, one of your old airlines, JetBlue, doing a deal with United today where they get to kind of trade slots a little bit, and they have access to Newark. You also fly. Breeze flies a couple of flights out of Newark. Is that really safe? I mean, in my mind, like, if the radar sometimes goes out for a couple of minutes, that's totally not cool. And I really wouldn't want to fly out of Newark if that's a possibility, like it's happened multiple times in the last month. What would you tell a consumer?
Yeah, it's 1,000% safe. That safety is not the issue. We have backup systems upon backup systems. That's not a problem. The challenge with flying out of Newark is when the FAA puts a ground stop or a ground delay program, and the flights are all running late. That's the challenge. We do have a couple of flights. We fly to West Virginia out of there on a deal we have with the state. But yeah, we kind of avoid congested airports for that very reason. In the New York area, we fly Islip, we fly Stewart, we fly White Plains, we kind of fly around it, and not only do you have airports where you don't have those ATC delays, but you also have a lower cost airport. If you were to just do Newark, particularly LaGuardia, there's $50 you have to pay in a facility charge on top of your ticket. So that's if you're trying to stimulate traffic and stimulate demand and stay away from ATC delays, those are places that we don't really want to fly to. There's plenty of demand in Stewart and White Plains and Islip and other secondary airports in New Jersey and other places.
I will say I flew into Newark on Saturday coming from Rome, and I'm here to talk about it. So there you have it. David, fantastic to get some time with you. Really appreciate it. That is David Neeleman. He is the CEO of Breeze Airways. Now, coming up, NVIDIA gains moderating a little bit. We'll discuss with Nancy Tengler. She is the CEO and CIO of Laffer Tengler. We'll get her thoughts on NVIDIA and everything else. This is Open Interest.